Good. To start looking at different areas, and this is looking in particular about how the new technologies, the DeFi technologies, which generally described as being Web3, but of course we're looking at more than Web3 today, can really impact the real estate sector. So just the housekeeping before we start. We've got a list of speakers in order. We put them into a sensible order. The idea was to talk about the tech first, then the real estate sector, and then look at some of the legal and regulatory issues. We've had to move things around, as always happens with things like this. We have speakers have got problems and issues and they've had to move around. So we're going to have to bump the order around. Don't worry about that. I'll deal with that as we go along. The other thing is housekeeping. You may have all had a box. Because of GDPR, me being a lawyer, I have to say this, we have to get your consent because we are recording this session and it should be available through both FIBREE and on our UCL webpage in due course. I'm going to first introduce Irina, who is going to set the scene, explain all about FIBREE and the ideas behind this event. Can I also just introduce at this stage Kyle McFadden? Some of you will know Kyle from the earlier events. Kyle is from Greystar, who are one of our main sponsors at UCL and is deeply involved in the consortium and this event. And Kyle has agreed to co-moderate this event with me. Should A, my IT break down, B, should I run out of questions or things to say, which Jonny Fry, my old friend, will say is unlikely. Kyle can field any questions that people have. I'm told that those who are joining by web can post questions in the chat function. And if you do, Kyle and myself will keep an eye on those. And after everybody's had a chance to speak, we will then move into a discussion mode and we'll raise a few questions that have been posed by people who are watching and a few questions that I've got that I'd like to ask. So I hope that's okay. If you've got any questions, please email Ruby, who's organizing the event. Mike Miller from Resilience, you may know. Mike's organizing behind the scenes. A lot of people are involved. We'll deal with that later, but Ruby is the point of contact if anybody's got any issues, and Ruby from UCL will sort those out. So if we could start now, I'd like to introduce Irina Karagyaur. There, Kyle's just popped up on my screen. Kyle, have you had a haircut especially for the event, or are you?
I actually comb my hair for the event. So.
Well, we are all very grateful. So that's Kyle. So if you hear the dulcet twang of a foreigner asking questions, that's Kyle. Kyle and I work with a lot of people on this, so we know what the issues are that are going to arise. I'd like to keep this as informal as possible, bearing in mind the current constraints of doing this across Zoom. Just so you know, we're broadcasting it on Zoom with live transcripting, so people who have hearing disabilities can pick up a live transcripting session, which is something we're very keen on at UCL. Right, Irina, if you'd like to introduce yourself and the event, and we'll take it from there. Thanks very much indeed.
Good afternoon, everyone. So I'll start from a short presentation about FIBREE. I'm just gonna share my screen. Sorry, some technical issues as usual.
Don't worry.
Everybody see, yeah.
It's always difficult setting these things up. Right, I can see that. Great, Irina, off you go.
So today's webinar is also part of FIBREE, which is Foundation for International Blockchain and Real Estate Expertise. It's a leading international network for exchanging knowledge between the real estate industry, IT sector, and blockchain technology. So today is the 5th global webinar series by FIBREE, our speakers of today. FIBREE runs a global webinar series, and you can find all the information on fibree.org for the upcoming webinars. And we are an international organization with 60+ regional networks across the globe. So if you have interest in real estate and blockchain, we'd like you to join our network or download our industry report. And the second global industry report, it showcases over 500 blockchain-related real estate products. You can find all the information about our regional chair and information about countries and different startups in different regions. So everything related to real estate can be found on FIBREE. And now moving to our topic today. So the reason why we're actually doing this event is because DeFi is one of the biggest areas of blockchain that's been growing exponentially, and the total value of USD locked in DeFi as of today is $42.9 billion. So DeFi is a financial software, so to speak, built on blockchain technology and has the potential to make financial applications more accessible to everyone. It is sort of a shift from traditional financial system to a peer-to-peer finance by decentralized technologies built mainly at the moment on Ethereum network. So here you can see the mechanics and how the layers of DeFi actually work. So the first is a base layer. In case of Ethereum network, we see Ethereum, then the application layer, DeFi, and a fourth layer of liquidity, which actually an end user sees. There are several areas of DeFi. It can be used for asset management, so through applications like wallets. Argent can be one of the examples. For compliance in KYC, for decentralized organizations, for data analytics, derivatives, developer and infrastructure tooling, DEXs like Uniswap, gaming, identity, insurance, lending and borrowing. Aave is one of the examples. Marketplaces, payments, prediction markets, savings, stablecoins, staking, tokenization, and more. So DeFi is really the space that is promising for innovation in blockchain, and that I believe will be one of the drivers of actually real world application of blockchain, especially for real estate. We also have technologies like Polkadot. So being head ambassador of Polkadot, I would like to also mention what is happening in the Polkadot DeFi ecosystem. We have a base layer Polkadot network protocol that allows transfer across blockchains. Then we have the protocol layer. One of the most probably famous and advanced projects at the moment is Cary, which is a DeFi hub for stable coins that allows users to transfer USD across different blockchains that are connected by Polkadot. And then we have an application layer. So you've probably heard of PolkaSwap and SushiSwap being like super on front cutting edge technology for like applications for using DeFi. Polkadot is still under development. So we are waiting for the parachain auction to begin and to actually launch first on Kusama and then on Polkadot network. However, Ethereum has already ecosystem in place. And today I hope we can hear from Aave, their experience on lending and borrowing and the potential of applying these financial services to real estate. So this is it. Trying to stop sharing my screen. Okay. I guess.
Yeah.
Yeah, Jeremy.
Hi, Irina. Okay, that's the introduction that you wanted to do at this stage. That's fantastic. Thanks very much indeed. We'll bring you in to look under the hood after other speakers have explained where they're coming from. But that's very kind of you to give us a general introduction, and we'll take it from there. This event came about because Irina became the joint chair of FIBREE with me, and we were scratching our heads as to what to do. And as Irina had started working with Polkadot, I started talking about how I'd met George a few years ago, who was one of the early investors in Polkadot through KR1. And George used to talk to me about parachains, and I used to nod sagely as if I knew what he was talking about. But the truth is, I did not have a single clue as to what he was talking about. But it seemed that George did know where the future was, because KR1 has gone on to invest in a great number of these loosely described DeFi platforms, Web3 and others. And therefore, Irina and myself thought that the event would be a good idea. We could do this with George, and the three of us could just talk about things. And it grew from there, because once we put this together, Irina started talking through her network to the other people who have kindly joined us, and it's grown out of all proportion. I'm delighted to say that Charles Kerrigan has now joined the call. Charles from CMS and I have known each other for a long time, doing talks about tokenization, algorithms, the future of IOCs and tokens and what have you. CMS decided to come in as our sponsor. So Charles will be able to tell us where he's coming from all of this later on in the event. But for now, what I'd like to do is to introduce George, who's going to explain where he's coming from. He's the CEO. I hope everybody's got the speaker profiles that Mike Miller put together for everybody. He's the CEO of KR1, which is publicly listed in the UK. It's still, if I'm not being rude, on one of the minor markets, but it means you can purchase shares in tokens through KR1, which one or two of us did a year or two ago. And they're also now available on the OTC, the unregulated Wild West that is New York, I think, George. But I thought it'd be great for George just to tell us where he thinks this market is going, and then we can gently move into how this new tech can really help us in real estate. So thank you, George.
Well, thank you, Jeremy. Thank you so much for having me. Yeah, we've been investing in the space for near on 5 years. So we were the first sort of token investment company, I guess, we started with this idea that we were seeing lots of people trying to get into the space and not knowing how in early 2016, and so we thought that if we could provide a publicly listed share, then people could gain access to a basket of tokens that way. There were 2 ICOs when we started out, so we didn't really have a full idea of what 2017 was going to be like, but we were hugely enthused by tokens, which is generally why we're all here today. In the early days, an Ethereum address would go up on a website, and you could fire off Ethereum tokens to it, and you'd get back tokens of another kind, and the whole thing just felt like it was just a massive leap in terms of how to take part in crowdfunding. Although in a funny way, it became more obvious that there was a second part to these ICOs, and that was actually token distribution. And what's been so fascinating to watch, the rise and fall of sort of token distributions, is actually how important the distribution was rather than the money, the fundraising. And when you look at current projects like Polkadot and how things have changed in terms of funding, we're seeing, you know, lock drops, stake drops, work drops, airdrops, all kinds of different ways of getting tokens out in sort of, you know, geographically spread across the globe into people's hands, so that these networks can float and work. And I think it's you know, hugely positive for the world to begin to understand that the token wasn't just a fundraising mechanism, although many people used it as such. And I think that, you know, panels like this come about because we can see that there are huge benefits to being able to sort of represent value and ownership on a blockchain. And there's so many different colors and flavors of how tokens can work. And I think at KR1, what we're most interested in is you know, tokens that you know, if you were to, you know, take it out of the system wouldn't work. And that was just a very early litmus test that we'd had in the ICO days, where you could very quickly get a sense that what you were being sold was what, you know, was snake oil rather than something that actually had a use. And so we very quickly latched on to proof of stake as an idea. It seemed that was a method by which, you know, tokens would have not only utility, but, you know, a sort of central you know, use case in, you know, these networks working. And so we started, you know, allocating capital in that direction, and that's, you know, been hugely beneficial for my company. And, you know, we were right in making that sort of strategic decision, as now proof of stake as a sort of central part of the ecosystem. And in fact, it's really only Bitcoin now, with Ethereum moving to proof of stake soon, that you know, will continue the proof of work method in the background. And so I think with that, with the move from Ethereum on to proof of stake, you know, I think that's the direction in which we're clearly going. And I also think that, you know, Polkadot shows that is the direction too that we are heading in. And, you know, tokens are global, they're 24/7 permissionless, they're fluid on the internet, and also they're programmable in the sense that not only is the token programmable, but what you're actually doing is you're programming people's behavior by how you program the token. And I think this is the bit that's most fascinating, in that when you're designing your network around what it is, you know, the use case that you're going for, you can program the way that people behave. Yesterday we were discussing, Jeremy, this idea that, you know, you can incentivize people to provide information to a network, and you can incentivize all kinds of data to be, you know, produced on a network. And but there's lots of different ways that we can all be incentivized by tokens, and that's really what I get most excited about. And so we look for projects that are, you know, designed in a way that will you know, elicit these responses from people and let these networks float. You know, without a middleman. It's in some instances, you know, I think these networks can grow globally, and well, that many obviously already are, but you know, really actually begin to change humanity and how we coordinate ourselves. So that's a sort of general token ramble from me about how excited I am about them and have been for a long time. And yeah, it's great that we're all here to discuss them further.
Okay, thanks, George. We've been asked, are you able to disclose how much Bitcoin, Ether, KR1 hold? I think my answer to that is no. I'm not your lawyer, but I'd like to. No, that's not the type of thing that I think George can answer in a public format. Sorry about that. But
it's quite all right. I did warn you they might come.
Yes,
questions, but that's fine.
Could you give us a rough idea, though, George, as to the scale of investments that you've got? And just a word about staking, proof of stake. As I understand it, proof of stake means it's quicker and easier and faster and cheaper to run the networks rather than proof of work. And it also gives people like you the ability to raise money by a return on investment, like interest, by staking. I've read one of the recent KR1 announcements yesterday about how much you staked in Polkadot. Could you just explain to people what staking is? That would be very helpful, I think.
Sure, absolutely. So when in Bitcoin, how it works is you have skin in the game, and the skin in the game is essentially your electricity bill. You plug in miners into the network, those miners hash, and in return for that, you have to pay the electricity bill. So that's your skin in the game, and that's how Bitcoin kind of kept all the sort of players in the system working for their own financial well-being, and that's kind of how it floats. What proof of stake was taking that skin in the game idea, but instead of plugging in machines into the network to perform the hashing function, what you do instead is you lock away collateral, and the algorithms and systems in place that accept that collateral can slash that collateral if the validator misbehaves. So it performs the same sort of function, but it does it without the machines. And in return for locking up your tokens, you receive a yield, a bit like how the Bitcoin miners receive Bitcoin for finding blocks. And in that way, and it takes some people to sort of sometimes get their head around it. These networks are inflationary, and Bitcoin is inflationary as well in a slightly different sense, in the sense that it is producing more Bitcoin, but obviously that Bitcoin production is capped. In the cases of some of these other proof of stake networks, they're not capped. The inflation will continue, so as to continue securing the network. And there's a huge debate at the moment about what happens to Bitcoin when the inflationary aspect of it comes to an end, and the network has to free float on fees alone, and that won't happen in the cases of these proof of stake networks. So that's how the system works. We do it at KR1. We have a number of staking protocols, and it's very significant for us to have this income coming into an investment company. It still takes a bit of management. You have to have a strategy, and currently that's working out very well for us.
Yeah, okay. We've had a load of other questions that we can't answer, or I'm not allowed to ask you about your position in Polkadot. But what I think I can ask you, George, which is I'm sure people would love to know, is what is the difference between Polkadot and Ethereum? At the moment, we're looking at building some stuff on Ethereum, which most people who use blockchain do. And I think Mark has joined us from Arv. Is it Ave or Arv? I never know how to pronounce it.
Arve.
Yes, thanks, Mark. I know you're Ethereum based. What if I could just move through with George, then we'll move on to another speaker. But George, could you just briefly tell us from your perspective what it was about Polkadot and their approach which impressed you enough to make one of the early investments? And do you think that the Polkadot approach is going to be the future internet, if I can put it that way?
Yeah, so we've always had this idea at KR1 that we were going to see a multi-chain world. There were so many different types of application layers that one could have, and they weren't all going to be serviced by one sort of blockchain architecture. That's what we felt. You know, some blockchains are going to do very, very high frequency sort of atomic trades to a degree, and others are going to want to do very, very slow, you know, don't break it view of the world, a bit like Bitcoin. But not only that, you're going to have public chains and private chains. There's going to be lots of different experimentation. And so in that regard, when we saw the original, you know, planning for the, you know, that when we watched, you know, Gavin would give his sort of design thesis on what Polkadot was, it chimed very much with our view of what the future looked like. We also, you know, we're huge fans of Ethereum. It's easy to sort of move off in various directions. As an investment company, you feel like you want to be at the very edge of things and see what's coming down the line. But really, Ethereum, you know, is a truly incredible invention, and that's, you know, partly why we're all here as well, is the legacy that's created. But it's a bit of a victim of its own success, right? Because it's not working to a degree. You know, the fees and the transactions all going through it. It's very full, and I think that's testament to a degree of the amount of experimentation that's going on in the space and how much there is to explore. And it's just not all going to fit down one you know, virtual machine blockchain, and they know that, and that's why, you know, we're moving to Ethereum 2.0. But Gavin, who we all know was a sort of core member of the original team, you know, he had a very strong vision of how he would scale Ethereum, and he's got possibly a 1 to 2 year head start in that direction. Yeah, for us, it felt like it was a bet on innovation, a bet on the future, and certainly at the moment, it's looking like it's a major contender. Will it be the internet of the future? It has a chance, of course, but I still think we're early in how all of this rolls out. You know. There's a huge range of experiments going on and projects, but I certainly think in terms of how a team delivers, in terms of the technology that has been delivered so far, Polkadot seems to be, to me, the main contender for the next sort of evolution of the space, and we're hugely excited to have backed it from day one.
Brilliant. Okay, thanks, George. Look, that was great. The questions are coming in now, thick and fast. So Kyle and myself will try and weed a few out to pose to people as they go along. Thanks for setting the scene, George. What I'm going to do now is I'm going to invite Thomas Wünsche from Greystar to speak. He was going to be further down the list. We were going to do more about the tech and then move into the real estate sector, how we can use it, before we deal with the regulatory and legal issues, the dull stuff, when people head for the exits. But Thomas has got another commitment that he's moved back for us. So I'm going to ask Thomas to come in now. He's a senior director and leads the Greystar business in Germany and Austria. Greystar are, I think, the leading developer of high-rise residential buildings in America and in Europe. They're a major player. They've been great supporters of our consortium at UCL for the last 1.5 years now. And I've had a number of conversations with Thomas and with Kyle and 1 or 2 others around the projects that we're thinking about as to how we can deploy some of our ideas onto Polkadot or maybe Kusama. But I think Thomas could come in now from right field and ask a few questions, to pose a few issues to the following speakers and to George, if he's still with us, as to how the real estate sector can really start to use this technology. That's what this event was about. It's about how can institutions, institutional funders, institutional investors, and major developers start to embrace the tech. So I'll hand over to Thomas. Thank you very much indeed.
Yeah, thanks, Jeremy, for the intro, and thanks for inviting me to that panel. So as you said, what I can offer today is more the real estate perspective, the conventional one, rather than providing solutions. I'll rather kind of pose some challenges that we as kind of professional investors in the space do see in our regular day-to-day basis. And as you said, kind of Greystar is a developer, investor, and manager of residential real estate. A typical day-to-day work from my team and myself does kind of look like that we do raise money from institutional investors. That could be insurances, pension funds, sovereign wealth funds, who commit a certain amount of money to us as a kind of real estate manager. In the next step, we do deploy that money into real estate projects, whether these are acquisitions, developments, and do manage these properties on an ongoing basis. So we kind of lease apartments, we collect rents, we pay service charges, etc. We also kind of manage the exit. A fund life typically ranges from kind of 5 to 10 years. So we're kind of forced to sell the real estate after kind of the duration of the fund has kind of expired. And then we do return the money to our investors, who subsequently hopefully commit another tranche of money to us. So it's kind of an ongoing cycle. And within that cycle, kind of the challenges that we see, and I'm really curious to hear the thoughts of the expert panel, is that there are certain structural liquidity constraints with investing in private markets. So investments are tied for a long time, typically 5 years plus. There's a limited secondary market, and as I kind of explained in the intro, typically what we do, we kind of force to sell 100% of the real estate and return the money to our investors without the investors having the opportunity to keep an exposure to the real estate portfolio that they built with us. So in that regard, I'm curious to hear where the panel sees opportunities to create a very liquid secondary market that could be accessed by not only professional investors, because I feel that that could be an interesting approach for institutions as well, who typically do not kind of suffer from the high entry barriers. I think that's another topic, but do see kind of liquidity constraints in their investments. And how we can kind of reduce that commitment time of, kind of typically around 10 years life. So that's kind of the first points I have on my list with regards to challenges we see in kind of the institutional real estate investment world.
Yeah, now that was very short and very much to the point. I mean, that is actually, if I can use the expression, a bombshell. People like Charles and myself and Jonny Fry have been talking to investors about tokenization of real estate assets, talking about funds and large investors wanting to enter into the sector for a long time now. But it does seem that very quickly the sector has grown up. And the big sale seems to be from the tokenization offers that I've seen, is this ability to create a secondary market. That seems to be where they're focusing at the moment. And if you, as one of the big players, if I can use that expression, in the market, feels that that's the way to go, that should be the wake-up siren, I think, for people to start taking this seriously. I don't know if you want to say anything more at this stage about it, Thomas, but that to me, it's the first time I've actually heard, if you don't mind me saying, somebody from the sector actually saying that, rather than somebody from outside the sector saying this is what those guys ought to be looking at.
Yeah, and I think, Jeremy, like, maybe it's a question for Jonny, Charles, and kind of the rest of the panel is just around, like, how do we get more institutions involved? How do we kind of get to, because, Greystar we're a GP, so we're we're basically, raising money and allocating the money to buy assets for return for our investors. But how do we get the sovereign wealth funds, the insurance companies, the pension funds? Those are the ones that really drive in the market. How do we get them in a better position for this to be more acceptable? And I think that's where we're trying to go. Obviously, a lot of these things start with retail first and then move into institutions. But I think with real estate, it should start with institutions first, and then the retail will come into play later. But I'd love to hear what maybe Jonny, your opinion is, and then Charles from a legal perspective.
Well, okay, yeah. So just by way of background, I've been involved in the sort of asset management business since the late 80s. And one part of me, I have to be honest with you, is very skeptical about the tokenization of real estate. And that's simply because if you look at the REIT market, it's tens of billions in size. It has, I think, 60 million actual people exposed to the asset class. And it's currently trading on about a 10-12% discount to net asset value. So if you wanted to take a building, take something iconic like the Shard, let's just pluck a number and say it's worth £1 billion, and then you go and tokenize it, well, you've just burnt potentially 100 million. Why would you do that? So I think we have to be careful about, it's not a silver lining. Having said that, I think there are some material benefits around the tokenization of all assets, property included. And one of those advantages could actually be the ability to start paying investors based on their duration of holding. So to put that into more simplistic terms, if I'm an investor in an equity, a bond, or a property, and let's stick with property, there's no reason why the rental income on that property cannot be paid to me on a much more frequent and regular basis. Now, whilst the direct owner of a property, you ought to get paid monthly, very often it's quarterly. As soon as you then wrap it into a fund, then you find that actually they make distributions typically every 6 months. And so as a regulator, treating customers fairly, why can't we provide individual investors and corporate investors with much more regular income? Very, very difficult to do in paper-based analog systems. But if the underlying asset is digitized, then you can actually have a through flow of income paid to investors, and it makes it a much more attractive investment for people putting together portfolios that actually are looking to create income. So whilst on one hand, yes, I'm a bit dismissive about, I don't believe it's a silver bullet to tokenize property per se. I think that perversely, you could find the compliance and the regulators actually are encouraging this to happen, because it leads to much greater transparency, and it leads to probably a better product for the end client. But at the moment, it's a lot of salespeople going around and say, well, if you tokenize this building, it means people, in Bangkok or Shanghai or New Delhi or anywhere else in the world apart from England, or anywhere else in Europe or anywhere else in America, can actually get access to this asset class. And we've seen lots and lots of people talk about it, and this has been going on now for, I would say, from what I've seen, nearly 4 years, and it hasn't really taken off in terms of successful tokenization of property.
Yeah, and I think it's an interesting point around the kind of the income distribution, because that obviously lets our investors put their cash to work on a much quicker basis, right? So I think that could be a very interesting sticking point around, because clearly we do distributions on a quarterly, semi-annually, annually basis. It's all based on paper transactions. Someone has to initiate the transaction at a bank, calculate the distribution, et cetera, et cetera. When you can actually have a much more compounding effect if you get it on a daily, weekly, monthly basis. So,
yeah. And the other thing, Carl, I think what landlords are going to have to face with given, we don't believe we're going to go back to a 9-to-5 office existence. And a number of the asset managers we've been talking to, and I'm sure Charlie will be able to come in on here, because CMS are one of the biggest real estate lawyers in Europe. And some of the people we're talking to, they're saying, well, we're going to have a much more flexible working environment. And it could almost be like clocking in and out how much desk space, how much physical space you've used today, this week, this month, and therefore your rent will vary accordingly. And trying to do that on paper-based systems, starts to becoming a real headache. So you might actually get more per square foot, but it won't always be let, if you see what I mean. So having that flexible ability, not only I think will be good for investors, but also potentially very beneficial for the actual owners of the property and your tenants, perversely.
Yeah.
Okay, guys, we've moved really towards the end, which is cool, because I did say let's keep it moving, and there's a flow there. I've been listening and talking to Jonny about this subject for years now, and I was given a number yesterday, Jonny, which you might be interested in. At the moment, there are $14.3 billion worth of assets tied up in smart contracts. That has grown from 690 million within a year. So there's been a move from 690 million to 14 billion in tokenization of real estate assets. Now, the argument that you've just made now is the one we've always been talking about. You can use a REIT. But now I do know that one or two people are asking the questions, well, what could we do with tokens that you can't do with a REIT? And we just touched on it. I know that Mark Zeller wants to come in, but I think just before we actually go down that rabbit hole, we'll just go back to the agenda. Let's hear more from the people at the coalface who can tell us more about what the tech does, and then we'll revisit this part of the conversation later. But that's been a really interesting insight into where this conversation is going. And I'd like to thank Thomas. If you can hang about for a bit longer, Thomas, that'd be really cool. But if you've got to go, we understand that.
Certainly.
Yeah. And if you've got any other thoughts before we do leave.
Certainly. I mean, I thought kind of Jonny's contribution was very interesting. Obviously, it is something that is a true problem in real estate, kind of managing existing assets, kind of operate them, collecting rents, paying service charges. If you can automate that, you can create a much cleaner and leaner transaction management platform, right? So certainly kind of huge benefits in that regard. What I just wanted to kind of reiterate on is kind of my thought around kind of tokenizing real estate. Obviously, first thought that comes to mind is kind of how does that compare with a REIT, right? How you access kind of retail investors potentially pay a higher multiple for the same cash flow, and that alone is like an appealing strategy. Where I was coming from is more to think of kind of how can we use tokenization in kind of the institutional real estate world. So kind of keeping it a private investment, but using kind of the benefits of tokenizing assets in the institutional world. So kind of reducing transaction cost, increasing transparency in the market, and also kind of to the point I raised, kind of increasing liquidity, because it will also be easier, that's kind of my opinion, to kind of transfer shares in a portfolio in a specific real estate asset to other institutional investors, but very easily and not in a kind of process that typically in our experience takes like 6 to 12 months, really.
Yeah, I think this is where a DAO could come in quite nicely for the kind of the technical individuals, but maybe something we can get into later on, Jeremy.
Yeah, absolutely. I'm sorry, I'm just we're getting bombarded with emails from people who want to join and are now about to join. It's turning into something which is rather it's expanding out of where we started. Thought it was going to go. So look, thanks very much, Thomas. What I'm going to do now is I'm going to move back to the original agenda and go back into look at the tech, I think, before we go back to revisit the questions as to what we can do with the tech. So I'm going to ask Yakub Sheikh now from Robonomics. We've got Yakub on the call, then Sergei. So if they can tell us really what Robonomics is about, what you're doing as one of these new breed of Web3 type businesses, and what's the type of work that's been going on in smart city and IoT data, which is something that we're all very interested in at UCL and at Resilience. So over to Yakub. Thanks very much indeed.
Yeah, sure. Thanks for inviting us to this roundtable. So first of all, Robonomics is not really a new project in the Web3 because the concept was born back in 2015 and the core team members are in the blockchain industry since 2011. So Robonomics is a futuristic, secure and serverless IoT and robotics platform on top of Ethereum and Polkadot. And its main mission is to bring the economy of robots into the first industrial revolution, making them autonomous economic agents. So since 2017, the team produced around 13 real-world use cases on Ethereum. And due to the bandwidth issues that George just mentioned, the team decided to move on Polkadot back in 2018 and has been developing the Robonomics parachain based on Substrate since then. So regarding some of those use cases that could be used in the smart cities, I guess it's important to highlight one of the cases of the team that won the first prize on the hackathon, where were some of the judges from BMW. And the case was about the road space negotiation for autonomous cars. Basically, it was about machines trading for a space on the road using the Ethereum and Robonomics. Getting also to the IoT part, it's really important to mention the case with issuance of green certificates based on the data from renewable energy sources. This is also a case that could be used right now in smart cities and different flats. Also, one of the cases that is somehow under the radar currently is the project DAOs. Probably, Sergei, how do you think, or would it be a good idea to share it here right now?
Yeah, absolutely, if you can do.
Yeah, you can.
Okay, okay, cool. So the project is about controlling the co-working space using the decentralized autonomous organization. So for example, someone using the DeFi instruments like Aave or something like that can fundraise a sum for opening a co-working space and then distribute the shares in forms of tokens of that space between investors or people who are willing to join that co-working space. And then using those tokens, they could, access the co-working space in an autonomous way with no humans involved, because they will have NFT keys to that co-working. And if we will scale this idea, this concept, we will get to the point where we can, make IoT lockers in our flats that will open to people with NFTs, which will allow you to create autonomous real estate lending services with no human involved, like autonomous Airbnb, right?
Yeah, and I want to add a little bit more about DAOs, because if we will say smart space, it should be a question not only about NFT tokens or about only about access to this space. For example, as Yakub mentioned before, we can present a process of collecting funds and grant access for developers in co-working without managers inside. But in the same time, smart space based on decentralized autonomous organization can be evolution of management of these places. It will be smart spaces, autonomous, economic, and based on the rules which will be presented in smart contracts in cooperation with just people who using these places. Investors who own of this property. And in these cases, what we have less transaction costs, and in the same time, we will have a fast decision making. Of course, we have a question about quality of tasks inside this place and other, but from the big picture, we can imagine autonomous spaces where machines can be part of our processes without someone who need to make connections between people with funds and someone who need to use these places. And one more from my side, I really like what speakers said before, their minds about tokens and functionality of these tokens. As a developer in crypto, from time when Bitcoin was $100, I remember that each step in the crypto was around new functionality of the tokens. For example, Bitcoin, it was the first, and Ethereum as a token which grant access you to much more functionality of the networks, create bigger market. So today, when we speak about real estate use cases of crypto and blockchains, I hope basically you will find more interest to create strong architecture of your token, more functionality of your tokens than just to create liquidity pool on Uniswap and get funds from our investors, what you can find in the world. So keep strong focus on functionality of the tokens. Don't be in stone mode about how it should be presented. It's RT20 or RT721. It's programmable. Every time you can create new type of tokens, and it's much more interesting for our market than to try to adopt what really now we have in crypto, because it's just a young market with a crazy time.
Okay, guys, can I just ask a question? Because you demonstrated to me and the team, which we can't really do today, one of your Robonomics platforms. If you could just explain, perhaps you or Yakub or both, what's the power of linking different blockchains together? We saw your demonstration of 3 or 4 different blockchains all running simultaneously and transacting with each other. I think that's the new, from my point of view as a non-computer scientist, that's the new thing that DeFi brings us, the ability of different blockchains to interrelate with each other in real time.
That's not really about the DeFi. It's more about the Polkadot that allows to more than 100 EVMs, with virtual machines, to interact simultaneously, while the Ethereum architecture, it consists of just one Ethereum virtual machine, which makes all the calculations, while the Polkadot concept brings in a virtual machine in each parachain connected to the Polkadot relay chain.
Yeah, but at the same time, if we will look with some vision of the next 5 years, I guess we will not to find independent blockchains. Because today you can find a lot of projects which try to build bridges. For example, for right now, first parachain from Polkadot development team will be Polka BTC, bridge to Bitcoin. And at the same time, I 100%, I guess I will be right, then in the next 5 years, all open public blockchain ecosystems will be connected between them. And in this case, you will just need to find interesting options in the one part union, new generation of internet technologies to, for example, to keep your tokens with this functionality. And in the same time, you will need to have oracles with other type of block producing time. So basically today, for everyone, I guess most important to find real workable technology like Ethereum, because in the next 5 years, it will be not so important what type of blockchain you will need to choose, because if you will live in Ethereum or in Polkadot, you will have bridges to another public blockchain network. So in our project, we try to connect Ethereum with Polkadot when it will be happened, but I guess we need to wait 2 years before that. It's maybe we will find some experimental bridges to Ethereum, but it will be bridges to Ethereum 1.0, but we need to wait next generation of Ethereum before we can say, hey, this is a real good Ethereum and this is good bridge between Polkadot and Ethereum.
And those bridges will be mostly custodian, meaning that they will be decentralized and there will be a single point of failure anyway. And also, I'd love to add that currently Robonomics supports all ROS compatible robotics and IoT devices. That is one of the most popular operating system for IoT and robotics on the market. And it consists of more than 200 devices for tracking air pollution, water pollution, and on the robotics side, there are a lot of drones. KUKA manipulator, for example, which is used on all automated assembly lines, is also ROS compatible, and it by the way draws some paintings under Robonomics control.
Yeah, okay. Guys, if I can just try and draw this together, because I've been really interested in token design for the last 3 years, and I was amazed to learn that there are 4 different types of tokens. ERC20, which everybody talks about at the moment, but there's T-Rex digital securities, there's ERC 1400, I'm reading from my notes, digital security tokens, and then there's ERC 777 NFT and gaming tokens. Now, I'm going to bring Kyle in a few minutes to talk about NFTs, and I know that Jonny's interested in NFTs, which is a totally different subject. But I think what we've got so far out of this, if I can just pause, is what we're saying is there's DeFi, which can bring in the funding and finance for real estate. And then there's also the Polkadot bridges architecture of multi-chains. And the two are actually different streams, if I can put it that way. You don't need to run a DeFi project on a multi-chain, and you don't need to run DeFi on multi-chains. You can run all sorts of things. Is that fair, Yakub, as to where, have I got it as a non-technical person, as a simple lawyer?
Yeah, I guess.
Good. Okay. Right. Well, that's been an achievement so far. At least I'm getting the hang of this. I'm going to confuse myself and probably others now by inviting Mark Zeller to come in. Mark is from Aave. Unfortunately, Ajit Tripathi, who I spoke to, who explained what Aave are doing to me last week, was pulled out and had to go to another call. But we're delighted that Mark Zeller, who's head of integrations with an Ethereum background, not a Polkadot background, is in a position to talk to us about what Aave are doing from the DeFi point of view. And maybe if you're in a position, Mark, to make any observations about some of the regulatory hurdles and issues that we're going to have to be looking at, that we will start to move into in a few minutes. But if I could introduce Mark from Aave, thanks.
Yeah, thank you very much for the invite. There's a few things I want to react on. First, the first thing is that it's our job for us engineers to make all of that easy. Of course, on the technical side, you have like the ERC 721, the AIP, whatever, all the technical standards that are very technical and boring for everyone. And our job is to make that invisible, because great technology is invisible. And it may seem complicated still now in 2021, but believe me, in Ethereum in 2015, it was much more complicated to use. And it's much better now. And believe me, we are doing 100% of our capacity to make it even easier to use. And at the end of the day, the end user don't care. Like, there's a lot of things that are happening in the background right now during this Zoom call to make this Zoom call happen, like port in your computer, DNS, whatever protocols that are used to make this Zoom call happen. But we don't care. We just have a very interesting and meaningful conversation together, because the technical stuff is not the important stuff. What is important is what we do with these new technical tools that we have, and this new financial tool. And what we do at Aave is that we are a liquidity protocol. So we basically is a way for people to provide liquidity and access liquidity in a decentralized way, in an auditable way, without any kind of middleman, and where you can directly interact with the protocol, and where the rules are defined by some technical codes and are the same for absolutely everyone on the planet. So there's no grade A and grade B citizen on the blockchain. Everybody is treated the same, and everybody exactly knows how many dollars there are in Aave. Like, when I'm saying right now that there's around $5.5 billion into the Aave protocol, you don't have to trust me. You are a few clicks away to verify that yourself. And that's the point of the technology. If you do that with any financial institution that you are currently use, the one that is linked to your debit or credit card, the one that is used for your saving accounts, you are not able to say right now how many dollars there are in this entity. Of course, there's financial audits. Of course, there's regulation. Of course, it's not exactly the same thing. But this level of auditability and trustless environment is unprecedented. And that's what decentralized finance is all about.
Yeah, okay. So can you see decentralized pools coming together to start investing in major real estate developments? Really, that's the exam question that people on this call are, I think, interested in.
Well, my first question is that why we are using the future tense here. Like, there's already billions of dollars of transaction for tokenized assets for real estate happening right now. I can quote easily retail-oriented implementation that is Realty. They are based in the US. And you can buy and sell a share of LLC. So it's very close to what I think you guys call a REIT. I'm so sorry, I'm not a lawyer, but you basically don't buy a token of a house. It doesn't make sense. You don't have a brick or a door of a real estate property somewhere. You have a share of a special financial product that basically own and manage their home. And basically with Realty, you get every week your fair share of the rent, because those properties are managed and there's tenants on it and they are paying their rent, and you have your fair share of it every week that are paid directly in tokens to your Ethereum address. And that's,
if I can just interrupt, that's what Jonny Fry was talking about a few minutes ago, I think. So you're actually committing some of the income flows to the token holders.
Yeah, and that's happening now. That's not future tense. That's something that was launched last year. That has, I think, Realty is like $40 million of assets and different properties, mostly in the US. Of course, that's a small and retail-oriented actors. In the background, the less retail-oriented, more institution-oriented actors. There's like hundreds of millions and billions of transactions that are happening now. Like, for example, as you can hear it, I'm French. It's very hard to hide that with my accent. Société Générale and BNP, very prominent French banking actors. They did financial transaction for real estate on the Ethereum public blockchain last year. They are still looking into it. It's something that is growing and something that is here to stay.
Can I just ask one last question then? What about mortgages and tenancies? I'm going to bring Kyle in because I know this is one of his favorite subjects. Is there any sign of activity yet of decentralized mortgages or financial instruments that give special rights to people who occupy or own property? Mark, that was a question for you. Do you know of any?
That was a question for me.
Yeah.
So basically, it's something that is, I think we cannot answer that question before talking about the regulation. So I don't know if that's another part of the panel or not, because basically, if it's a share of some kind of special purpose vehicle to own the properties and whatever, or directly the tokenization of the property, which doesn't make a lot of sense, but why not? In either way, you cannot do that in a permissionless way. Like, it doesn't make sense. You will need to have some AML, KYC implementation that happens because there's some real world assets out there. So that's a real world asset with an owner and all these kind of things. And what is interesting is that a lot of people think that because it's decentralized, it has to be permissionless. So anybody in the world, even potentially, and compliance department know what I'm talking about, bad guys can interact with it. But that doesn't make sense as well, because on the technical side, if you have a decentralized architecture, the smart contracts, all the thing that works today that anybody can access, but with a very small module that manage what we call a whitelist. And in order to get inside the whitelist, you have to prove your origin of funds, who you are, and whatever compliance check spots you want to check. You end up with something that is at least closer to something that is more compliant, at least in the good way. In the path of being in the good direction. And when you have that, you can, even in a public decentralized blockchain, have this kind of offerings. And if you have this kind of offerings, you can have mortgage, maybe I'm lost in translation, but to my understanding, it's taking a loan to buy a house and also using your house as collateral to take a loan. I don't know the subtlety of in your territories to say that, but both works. And using those kind of assets of collateral can work as well. And the main challenge are how to give a price to it, because real estate and real world assets are not as fungible and as liquid as the other assets. Like, for example, one Bitcoin is a Bitcoin. So you have a decent idea of what is the price of a Bitcoin, and nobody cares what your Bitcoin is in particular, because you can sell any kind of Bitcoin for roughly the same price with a few coin analysis explanation on it. But for real estate, it's not exactly the same. Of course, there's a market, but every house is unique. So it's non-fungible. And as we are going to talk about non-fungible tokens, that can be an interesting parallel as well. And in order to define a price, you need to define also a secondary market for this kind of tokens. And that's
back to the secondary market point that Thomas was making before.
And the real challenge to me is, what is the regulation for that secondary markets? Because if you have a regulation and a full KYC for the primary market, so you cannot buy a share of a LLC of a rate without identifying yourself, but on a secondary market, anybody can buy and sell, that might be some regulation issue down the road.
Okay, guys, I'm gonna call just to stop now to that, because we've moved into the regulatory piece. And just before we go there, and thanks very much, Mark, because we could actually do a whole session on each of these individual parts. So I've promised Kyle that we would just do 5 minutes on what he's really interested in, which may be crystal ball gazing, it may be long-term stuff, which is, what's the power of this stuff? What's the power of this tech to improve the way in which we look at real estate? So this is more of an academic university view. rather than a here and now nuts and bolts return on investment view. Kyle, do you just want to mention where you're coming from as to how we can start using the tech to improve people's lot in real estate?
Yeah, I think, the way I look at it is how do we make real estate a more democratizing force for an everyday individual. So I think with the power of something like an Aave, it gives a lot of individuals with any crypto access to a high yield savings or loans, etc. I guess, how do we mirror that with real estate? How do we get that? How do we make this more available to everyone, not just people who own real estate, but people that rent real estate? I know, George, we've talked about this last week about how a lot of times having a physical asset does make things more difficult, but that's where I'm getting to. It's like, how do we use this as a force for potential, equality or combating inequity within the real estate market? I don't know who wants to take that, but
we don't seem to have any volunteers.
Stunned violence. Look at that.
Look, I know that this is something which we've got to look at, and one of the things that we're really keen on is using the data from the buildings to improve tenants' positions. All the new Grenfell Tower rules that are coming out are about tenants and being empowered to report information, to know what's going on in their building, and for owners and managers to know what's happening in the building. And I think it kicks through into the investment. So if the building is more managed in a more modern way, and the data is being held and used and can be projected to the guy in the fire tender on his way to the fire, which is the actual test that we've been given by the Grenfell Tower inquiry. How can you get that critical data to the guy in the fire tender on the way to the fire? If we can capture that data, I think it starts to improve the ESG value, and the investors might start putting more money into certain types of buildings. And it's that type of view that we need to be building on. So it's improving lives, it's improving buildings, it's making them more flexible, it's making them more modern, it's making them more ESG. And I think people, Kyle, call it the S in ESG, but I can never remember what
social
G stands for.
Environmental, social, corporate governance, you judge.
Yes, thank you, Jonny. I was actually just going to bring you in here.
Jeremy, can I come in? Because I think another thing, and I know we've talked about this before.
Yeah.
According to Aon, one of the biggest insurers in the world, they claim that 90% of all the information on a building is inaccurate or incomplete from when it's built to the first owner.
Yeah.
And that's because whilst most of the people on the audience or on the panel today are very involved in things called crypto, things called DeFi and NFTs and all these terminology which we throw around because we're engaged in that sector. But actually, when you go into where the real money is, when we're talking about sort of the institutions who are looking after trillions, not billions, then what they want to see is, okay, I want to understand, how do I go from a paper-based analog system where the information on that building could well be on a laptop, on a fax, on a written letter, in a filing cabinet, and you're going from that sort of system to a digitized structured information. And once the information is then in a structured format, then experts like Mark Aave can actually come in and start creating and using the information and creating real value. But just coming back to the very, very real world, if you're an insurance company or an underwriter and you've got two buildings, and one building you know all the information about, and the other building you only have 10% of the information, which one presents less risk for you as the person that's going to insure that building? It has to be if you have all the information. Are all the fast certificates in place? Have all the health and safety checks been carried out? Because there's chances are there's going to be less risk. And I think just very simplistically, that on itself is a huge driver for owners of real estate to start looking at their portfolio and actually just getting their filing in order and putting it in a format where they can share this information. And I think one of the key attributes of blockchain technology is that if it does one thing, and if there's one thing that people can take from today, then please take transparency, because the technology can give transparency If you've got transparency, then it can hopefully give you greater trust. If you have greater trust, then most certainly it will give you, in many cases, lower insurance premiums, and potentially it'll give you a higher value on the actual asset. And I think that they're very, very tangible things which non-technical people ought to be able to understand and start putting that into place. And it's not trying to convert the cyberpunks. We have a job here to try and convert people with trillions of assets. You mentioned 14 billion. I don't want to be dismissive, but you know, if you look at the unencumbered value of commercial estate in the world, it's running at about 25 trillion. Just in the UK alone, residential property is 5.5 trillion of mortgage-free assets. So actually talking about billions is, yeah, okay, it's a good start, but we want to start talking about trillions, and then you've actually got a serious business. So you can't expect to make that jump from where we are to where we want to get to, but we have to start educating people and putting that infrastructure. And that's what we're beginning to see, Jeremy. I know we've discussed this before, but I hope that gives you some sort of sense of some of the things which are going on out there.
Yeah, and just whilst you've got the floor, if we can just get your view on what you've described as nudge economics, because we're about verifying the data. That's all the stuff we're doing at the university. Ruby, I don't know if you're there. Are you able just to give us a quick plug for the university, the UCL webpage that people can refer to? Maybe if Ruby can't do it now, we'll put it on a bit later so people can actually see where this resource is going. We've had 4 events, they've all been written up, and people can log on, join, and they can participate in some of the events. We're thinking that it's actually about verification of data. There's too much data, which is back to the discussion that we had with the Robonomics guys. My worry is that the IoT devices are going to project far too much information, and a lot of it could be wrong, could be useless. So there's a big step before we can just take the data and machine it. You've got to start verifying it. But could you just tell us, Jonny, what your view is about nudge economics? It's something you've taught me about, and I think people would just like to know what your view is as to that small baby step that is important that we can learn from the technology. Okay,
so nudge economics, I'd love to claim I came up with it, but I most certainly didn't. It's been around for about 20 odd years now, and it's been used by many, many governments. And if I can give you some really basic, simple examples, most of you, regardless of where you live, you probably have 2 dustbins or trash cans if you're our cousins across the pond. And the idea of that is that you put your recyclable products into one bin, paper, glass, plastic. You put your household waste, it may be food waste, it may be other items that can't be recycled at this stage, into another bin. So you're being nudged, you're being encouraged to become more environmentally friendly with your, with your rubbish. If you get into someone's car, social distancing allowing, you'll see they have something called a seat belt. You're being nudged. Car manufacturers have to install seat belts into cars, and you're being encouraged to clunk click every trip, as the advert used to say. So what this is that you see many, many examples of governments nudging and encouraging you, either by fining you if you actually submit your tax returns late, or encouraging you to do more savings by giving you tax relief on your pension contributions. And so the reason this is potentially relevant when you start looking at data is that if you're encouraged to share your information, or if you're encouraged into doing some sort of action like maybe turning a light switch off or turning your heating down, then why can't you be rewarded because you're actually doing something for the benefit of potentially others, much, much more ESG friendly. But let's give a real tangible example. Many of you would be familiar, and sorry for those that have heard this example before, but many of you are familiar with the company SC Johnson, who do cherry blossom boot polish and Glade air fresheners. And what they want to do, they wanted to be seen as be more environmentally friendly, because a lot of what they produce is in sort of squeezy bottles and then just get thrown away. So they teamed up with a charity called Plastic Bank, and they basically said, okay, we will give you money for plastic that you pick up and recycle off of your streets, off your beaches. And this has been hugely successful in Indonesia and Malaysia and Egypt. But instead of giving money, what a surprise, the kids are walking around with one of these things called a mobile phone that's constantly glued to their ear. So rather than giving them money, which could have got stolen or actually taken off by dad, who went back down the local pub and had a couple more pints, they actually had tokens. And those tokens then could be exchanged for, you know, books, clothes, food, medicine, etc. So there's an example of nudging, encouraging people to change their behavior, do something for their local community, and then they were rewarded with a token in a digital fashion. And we believe there's many opportunities in real estate to actually encourage and foster that sort of change of behavior, not by saying we're going to put your costs of living up if you don't cut down your carbon footprint, but we're going to encourage you to change your behavior, to do things, and we're going to reward you accordingly.
Yeah, good. Okay, well, thanks for that. We've got, as George mentioned, one or two others. We've got something we're working on called the Cool House Project, because it's cool and it's air conditioned. And we're seeing if we think that there's probably a big role for incentives for people to do things across the entire sector. So, for example, we know that there are 500 prop tech new companies out there, all of whom are inventing very clever things to do with the management of real estate. So we think there's a small service that actually has come out of the university, out of this thinking, that we might be able to put together. Right, we've had the crystal ball gazing, we've had what the market want. I think it's chance now to go over to Charles Karagyaur, who can, it's like inviting a grown-up to the party, if I can say that without being rude to everybody. Charles can now pour some sense and reality onto the discussions, because Charles is, I think, at the cutting edge as much as any other lawyer that I know in this town or in this country, involved in IT, banking, real estate, and the like. So I think, Charles, the question for you is, does the regulatory background prevent this type of innovation that we're talking about?
Thanks, Jeremy. And apologies you can't see me. I'm suffering an internet outage today, so I'm on a telephone. So the short answer to the question is that people should be reassured that there are no legal obstacles to this type of structure or transaction, and we have done it. So if we're talking about tokenization as a broad concept, the rules tend not to look directly at the application of the technology. They look at the underlying transaction. And so what we're generally concerned about is making investments available to either qualified or non-qualified investors. So in particular, offering securities to the public, as the Companies Act would have it. The reason that's most relevant in this context, and Anthony makes this point in the chat, is you have to frame the question by reference to what you're tokenizing. And there's a difference between tokenizing the asset directly, the real estate, and tokenizing the shares in a corporate vehicle that owns the real estate. We're generally, in practice, doing the second, because that's easier for the reasons that Anthony has identified on the chat, that in the UK, the land registry isn't built for native digital assets. There are workarounds, so you can register the ownership of a piece of real estate, the legal ownership of a piece of real estate with the land registry, and then tokenize the economic ownership behind the scenes. And that is essentially how most of the transactions have worked in the UK. The other rules that apply, again, are fairly conventional, as would apply to any other type of corporate or real estate transaction. So this isn't difficult. The rules are still changing. And most jurisdictions are updating their rules to accommodate native digital assets rather than the kind of workaround that I've been describing. And everyone's in a slightly different position in that journey. We're also all updating the rules as they apply to smart contracts and automation. And so you may find yourself touching on regulation as it applies to data, smart contracts, and other things that are ancillary to the underlying project. I just make a couple of points in practice on these questions of why are we not doing it? And I've got the same thought process as the others, and I've changed the question that I used to ask a couple of years ago to institutional clients, where we'd say, are you interested in tokenization? And they would generally say yes. And then as Jonny in particular is saying, we're then sort of wondering why they're not doing it and waiting for them to give us that that assignment. We now ask the question, what's stopping you? And we get a fairly consistent answer, which is that this is now something that is squarely on the desks of institutional funds. They're looking at it. The difference between those deals that haven't taken place and the ones that have taken place are generally that the ones that have taken place have used an exemption. So we have the ability to do small transactions without incurring the cost of a prospectus that's used in issuing securities to the public. So if you do a deal below 8 million, then you can do a short form style of transaction. And that is a much lower cost option than going to a full form prospectus. Most people who are coming to this market are attracted to it because it's quick, it's efficient, and it's easy. And therefore, faced with a long form prospectus, the cost and time associated with that, they tend to be put off by it. So we've done a number of transactions using the exemption that are short form transactions. I think some of those will evolve into further issues that will use long form transactions. And we're having a couple of those conversations at the moment. So we're sort of in a balancing act between the benefit of doing it this way initially is, well, the long-term benefit is all the things that we've talked about, better price discovery, transparency, efficiency, cost reduction. But there is an initial cost to doing a long-form prospectus in a compliant way. So when people come for the benefits, they find that there is an obstacle before you get to them. That means that they use the exemption, and that's now pretty conventional. What we're finding, I think, is that the second generation of those transactions will likely use long-form documents, and other jurisdictions are more open to them as far as access for retail investors. So there are a couple of Asian transactions that we're working on at the moment, and there seems to be a particular ambition in Asia to get this market seeded, and clients are more prepared to do the initial work and spend the initial cost in doing it. But to kind of summarize on it, tokenization is not a difficult thing. It may still be relatively rare, but I've done tokenization transactions for real estate, debt, equity, invoice discounting, rare whiskey, other types of provenance transactions, supply chain finance. They are not hard to find, these transactions, if you know where to look.
Well, Charles, actually, I like what I hear. I used to speak on these events about ICOs. My worry was that they were unregulated and people were going to get their fingers burnt. And people used to boo and throw eggs at me and what have you when there was a flurry of action in Barcelona and other places where the money was being raised. But I want to see full prospectuses, and there won't be a full prospectus until there's an economic reason for somebody to spend all that money on a full prospectus. And that means it's a heavyweight institutional size transaction. So I think we're getting there. From what you're saying, people have done the 8 million and below exemptions, and the next big move is going to be somebody who goes for a full security. Is that where we are, do you think?
Yeah, I think Jonny and I have had this conversation a few times. I think that in tokenization, DeFi I think is more difficult, but in tokenization, there is a scramble to be second to market. And I think as soon as one of those institutional names does a tokenized retail-facing transaction, we'll see a number of others in pretty short order. But that will also seed the market for other types of digital securities, digital assets, automation, all those kind of things. And the point that you make about data and access to data, I also see people working on different approaches to accessing data. So we know from these conversations and others that blockchain provides transparency, and I'm certainly someone who's worked on blockchain projects, and I'm an advocate for it, but equally there are other ways of doing it. And we see people who use natural language processing technology to do that kind of searching exercise, so that all of the things that used to be first lost in dusty boxes and then lost in the bottom of email folders can be accessed even if the data isn't structured. So you've got alternative approaches, I think, vying to reach the same destination. You can structure the data using blockchain style technology, or you can have unstructured data but better tools to access it and make it available for the same reasons.
Good, yeah. Okay, Charles, thanks very much for that input. It's nice to know that this isn't talk anymore, this is actually happening. I'm going to move completely to the subject that everybody wants to talk about, which is all about non-fungible tokens, NFTs. I'm going to ask George first, because in his spare time, I learned this week, George is a bit of a geek on NFTs, and I think he writes a blog. Is it under an assumed name, is it, George, or are you going under George McDonough? NFTs.
It's actually a podcast. That I've been doing the last year and a half in NFTs, but I tend to keep my day job and the podcast fairly separate. NFTs was a very playful area of blockchain, still is, but you know, I was knee deep in white papers and you know, layer 1 protocols, and suddenly this area appeared of people doing art and there's all manner of different ways that you can treat unique tokens as opposed to fungible tokens, and I wanted to explore that area, and it's actually I did feel that it was going to explode into something really exciting. I just didn't think it would be quite this quick. It's all started with a project called CryptoPunks, and they just created some on-chain art of these little characters and gave them away for free to anyone who wanted them. It's like everything on Ethereum in those days, and even now, it was very experimental. It was fun. It was like, can we do this and try it out? Let's have a go. And CryptoPunks are now changing hands for upwards of $8 million a pop, which is truly extraordinary. And there's plenty of other extraordinary things happening, but I think again, there's so much you can do conceptually and experimentally with these kinds of tokens. There's a fascinating project called POAP, or Proof of Attendance Protocol, and these are things you can turn up to conferences, and you get your proof of attendance in your wallet, and then 2 years later, if you happen to have that token in your wallet, you can then get access to a different conference, or you can get access to other things. And I think that's a sort of the first iteration of a concept that is now going to blow up and has actually got huge implications in terms of identity and how you can prove your identity. It's got huge implications in terms of the music business. If you ticketing, and allowing people to interact with fans, and there's a huge world to explore in the NFTs, and I've been enjoying doing that. From an investment perspective, will will the NFT space and KR1's world merge? Certainly, there's potential there. It's much harder to start making investments in people's artwork because it's so subjective. Sure, there are platforms behind the scenes with NFTs now that are looking interesting, but it's much easier to spend one's own money on NFTs that are fun and interesting than it is to spend other people's. But yeah, certainly I find it an absolutely fascinating space, and it is more than art and music and things like that. It'll find its way into the, shall we say, more kind of boring world of like invoice factoring, and there'll be all manner of different ways that people will use this technology, and that's why it's so exciting to track it.
Okay, well, Irina, I know, and Kyle have been talking about NFTs. I don't think they're just hooking their caravan to the latest bandwagon. That would be mean of me. But I'm sure there's something that we could be doing here for real estate around specific parts. I'm going to ask Irina and then Kyle. And if anybody else wants to jump in, Sergei and others, we've not actually had a chance to talk this. I don't know where this conversation is going, but I just suspect that it's worth having the talk anyway. So Irina first and then Kyle, then anybody can jump in who wants to. Irina.
Yes. So for me, NFTs are really a representation of ownership. So we had 3 different eras of internet: the distribution, when we had like Medium as just a source of information. Then we had subscription era, platforms like Spotify, where you could still do advertisements. You can be a creator who owns revenues from the platform. But now we are in the ownership era. So NFT is just like JPEG file or any other file that we transfer on the internet, but it has value now because it has unique identification. It can be tracked on the blockchain, and it can contain different types of information like music, image, certificates. So we now can do sales of NFTs. There are more platforms coming to the space where you can tokenize your collectible piece of art and then put it on the market and trade it on the market. You can still do subscriptions, advertisements around it, create royalty sales, and there is more appreciation for the token because token can have a unique image, or you can have a real world, I don't know, object, and then you can have a token that has more information about this object. So if you have a bag, luxury handbag, you can put, or a bottle of wine, you can put a non-fungible token and information about where it's been produced, the exact date, some specific information. And for instance, you want to store this bottle in your canteen, but at some point you want to drink it, but you still have the token representation that reminds you when you bought the bottle and what was the value of it. So this is the exciting thing about NFTs, that they provide more additional information, and you can play around with images and 3D representation of it. So for real estate, it can be any type of certificate with the image of the building or layout of your flat, or any other type of data.
So flyovers and visuals and graphics and things. Okay, the chat has suddenly gone red hot. As soon as we mention NFTs, everybody wakes up. So people are talking about it being about ownership and individual assets, but I can't see that there's anything new here, to be frank. Everledger was one of the first blockchain solutions that I ever heard about, which was people doing individual blockchain certificates for diamonds. So each one is an NFT. So you can sell the diamond by transferring the token. So I'm not convinced that this is new, but everybody else is telling me it is. Kyle?
Well, yeah, I think I think a part of it is around scarcity, obviously, right? That's what's really driving a lot of these valuations is the scarcity. It's a 1 out of X, which is the same in any type of collectible market where value is very subjective. And I think that's really like the key part of NFTs. And from a real estate perspective, like Irina was saying, you can do this to a building, because most of these buildings they're all one of a kind, right? I know we've talked about more boring use cases in terms of an NFT around a document, particular documents, and so that's how we organize the data. But I think something that, it's interesting to me, it's probably not something that my company would look at, but the virtual real estate and how people are going to be creating entire kind of real estate investing arms to invest in real estate, virtual real estate, because people are buying them, and it's become a really hot market. I forgot the name of the company, but I know some of these assets online are selling for millions of dollars for virtual land. So it's, I think that could be fairly interesting going forward. I see a lot of people have their hands up, so I'll
Yeah.
I think Jonny, you were first, had your hand up, so why don't we start with you?
Okay, so once a week we write an analysis trying to look at how, where, and why blockchain and digital assets are being used. And this is something which organizations then take the content and they talk to their clients and staff and what have you. And we wrote an article this week which we entitled NFTs, Pandora's Box, or a pot of gold for litigators. And Jeremy, you would know better as a judge to make a statement like that, saying that NFTs, it's just old hat and it's all hunky dory. The reality is that it is an absolute dream for litigators. Absolute dream, because you've got to prove that you've actually owned the thing that you've sold in the first place. But let's take that leap of faith and we get a proper lawyer to sort out rather than yourself. Someone of Charles's caliber would be probably ideal. But joking apart, what NFTs give you is very, very similar to the whole disintermediation of money, which is what a lot of the cryptocurrencies were originally about. Stripping away the layers, and if we look in the entertainment industry, stripping away the layers of agents and managers and all the ancillary costs there. And there's numerous examples of where you're now seeing people that own something which was IP, fairly intangible, and it's becoming an asset class in its own right. So if you own a photo, if you own a script, if you own images, and just to give you some idea, one post by Dwayne Johnson on Instagram commands $1 million. So he's only going to do one post to get $1 million because he's got 187 million followers. There's a girl who on TikTok is actually earning 5 million a year just by posting images. But what she doesn't realize is that those images they're out and anyone can use them. So if you can actually now register your IP somewhere and then sell the rights to that IP, it opens up a huge market, almost anything. And in terms of valuation price, they are unique, but that hasn't stopped you valuing things like classic cars, things like art itself. There are indices which can give you an idea of what they may be worth. So I think it opens up a huge opportunity. And I think some of the work that Polkadot are doing, Rana touched on there, I think in the real estate industry, NFTs represent a very, very interesting opportunity. The challenge is going to be, however, lack of regulation. Property isn't regulated though, and it's still become a multi-trillion-dollar business. So that shouldn't necessarily put things off, but we do probably need to have a wrap around the on and off NFT ramp to encourage the regulators to perhaps have a little more comfort.
Okay, what I'm going to do now is I'm just briefly going to explain to people what the consortium's doing at UCL, and then I'm going to bring Joe in to talk about FIBREE. This is our page. You can see the link at the top. If you want to talk to us, join our mail list. We've written some decent papers. We've had events in smart cities, the future of construction and the future of cities, where we had, I think, over 120 major real estate investors on the call. We've looked at data in real estate construction and operations. I suspect that the conversation we've just had about NFTs is there. I think, Charles, that if you could prepare a Bible for a transaction as an NFT, then that makes the transaction a lot quicker. We started here because our sponsors asked us to, Naveen and Greystar. We've moved into operations and smart cities, hence the Robonomics guys who are on the call today, which we're interested in. We haven't really started on the transactions, and I suspect that that's where the NFT debate comes in. Charles, any response to that? Do you think that's a bit too far of a leap?
So I'm getting inbound inquiries in two respects. One is the one that everyone would expect. So musicians and content creators and the general ecosystem around that. So we're looking at those questions and making connections to the folks that can partner on the technology. But then, yes, the second is in relation to documents of value. So there's a legal distinction between a piece of paper that can be copied. So a contract, you can make photocopies of it. It doesn't change the nature of the contract. But something which is what we would call a negotiable instrument. So the technical definition of that is title passes by delivery. And the best example is a £5 note. Those things are significantly relevant. So in the world of intangible assets and the examples that you and Kyle are giving around pieces of paper that have could have intrinsic value if there is a way of managing this is the documentary version of the Bitcoin crypto double spend problem. So now we can do that, and it does open up those sort of possibilities. I think we're too early to know where it goes for sure. You wouldn't ask a lawyer where this is going, but I can certainly tell you that there are any number of people that are interested, from institutions to individual creators, through to obviously all of the service providers and platforms that have been working in crypto assets for some time already.
Great. Okay, thanks, Charles. Right. Just before we wrap up, I'm going to ask Joe Bronkers from FIBREE, who's been very supportive for this event. He's been supportive, helping Irina and myself. Just a word of thanks to the people behind the scenes, to Ruby Saw, McDonaugh from BREI, and Mike Miller, who've toiled mercilessly behind the scenes to put this together. Joe has been very supportive from the Netherlands, and I'd like to introduce him very briefly just to tell people what FIBREE are doing, and then if anybody's got any final questions, if you want to put them on the chat, and this is open of course to people who are watching as opposed to just joining the discussion, I'll try and field those questions before we wrap up in about 5 minutes time. So Joe.
Yes, thank you, Jeremy, and hello everybody. I'm from the Netherlands and FIBREE. I missed the beginning of this event, and we are a global organization bringing people that want to investigate and explore the intersection of blockchain and real estate. And it's, I think the topic that you discussed today really is amazing. It's very nice. We are a global organization. We have different working groups. So we look in a working group on tokenization of real estate, and also try to understand what is the benefits of that. And I heard a lot that has already been said here today. But I think that creating liquidity, a potential way how tokenization can contribute is because also properties that are less liquid, maybe if they're in a secondary city where there's not so much investment activities, and you have a large building, you can cut it in smaller pieces and you can create this liquidity. And by doing that, if you're an existing investor, you develop that, you can add value because you can reduce the risk of being sole investor in such a large building in a secondary market. I heard Jonny speak about the value of having information about buildings and bring all this information along the life cycle of a building together. And we understood this as one of the fundamental things that we need in the blockchain space for real estate. Because if you compare investing in real estate, actually what you do is you want to know as much as possible about the investment, about the asset. You want to exclude as many as possible risks. And the real estate investment, the building, is a complex structure. There's a lot of information that you need to assess, but this information is stored in many different silos, and everybody holds a piece of the complete puzzle. But how can we bring this together? And this is going to be more and more important, because in the past we had one owner of a building, we had one tenant, we had large contracts for long periods, representing a lot of value. And then it was interesting to hire all these intermediates to help you assess this. But in the future, we have multiple investors for one property. We have multiple tenants renting for shorter periods. They do not only rent the bolt space, but they rent it together with lots of facilities. And how to administer this, it's becoming exponentially more complex to keep this information. We are entering in the post-COVID era, where maybe having more information about, let's say, the quality of the air, the well factors of a building become more interesting. So again, more information is needed. We're entering into a world where circular economy and sustainable performance of buildings and scarcity of materials will be there. And again, once we invest, we actually need to know how this building can be disassembled somewhere in a faraway future. It's all about how are we going to store and keep this information in the right way. And this is really a complex story in the way how we do it today. So we, as FIBREE, we thought we have to start building infrastructure, an open source infrastructure, how all those silos that hold a little piece of this entire puzzle, how they can better be connected, so that on the moment that you have the role that you may access a certain part of this data, that you can better connect and identify the sources that hold parts of the puzzle. And then I think when we talk about the topic today, decentralized finance, if we manage to bring information together, what we do in FIBREE, what we call the project unique object identifier, if you manage to organize that you have all this information, I think the next step is how can we identify processes that are occurring on a high frequency? Because that's where I believe the first use cases and the first benefits can be found for applying decentralized finance. Because then, for example, if you want to tokenize a real estate, you have to think beyond how we used to think. If I'm investing in an apartment building, but if I can also invest in the supermarket next to it, and I can make parts of these investments available with tokens to the people who live in my apartment, for example, you can not alone create a win-win for investing in an apartment, in a shopping center, where when the shop does well, the investor does well, but you can add something extra. The residents in the building, when they own a token of this investment, they benefit from going to the shop nearby where they spent the money. They can help being a good supermarket. The supermarket can be a good tenant, and the investor, and also they can have the return for that. So you can create, if you talk about ESG, you can create extra possibilities for the S factor, which in fact are very, very difficult to realize. But I think all these things are possible. Yeah. But we have to start at the base, and I think the base is how can we create this complete overview? How can we put all those pieces together and keep them together along the life cycle? And I think that is something that network as FIBREE can do along everywhere in the world. We can start doing pilots and find out how we can puzzle this together. And actually, we encourage you all.
Well, thanks very much for your support. Really very grateful. Okay, finally, guys. The Robonomics guys have been a bit quiet for the last hour. No, I don't mean any disrespect to you. I'm really grateful. Have you got any last thoughts as to, have we tempted you to move into this space?
Yeah, for sure. I mean, first of all, I'd love to make an input regarding the collection of data from the IoT devices from different smart buildings. You know, when you are using RS compatible devices connected to Robonomics, it's pretty easy to build this kind of database that can collect data from different sensors while and gathering them in a decentralized way using Polkadot, and also storing that data with GDPR, with the GDPR compliance, because you know, we can interact with other parachains in Polkadot, adding additional privacy layers, for example, by interacting with Fala. And also, I'd love to add to the NFT part. George, please correct me if I'm wrong, but as far as I know, there is no any cases of an NFT token produced by a robot in the whole crypto industry, in the history of the blockchain.
So I missed that.
An NFT token produced by a robot.
Right.
Oh, I see.
As in like a robot artist, or
Yeah.
Yeah.
That's exactly what we are currently working on. You can visit our Twitter account and see there the GitHub page shared by Sergei, where you can actually see the code and how it works. And also we are currently like expecting a delivery of a Boston Dynamics spot robot. We've got everything ready on the development side to play with it and connect to Robonomics parachain to issue NFT tokens. For example, when you like put a camera on it and like filming a real estate and mapping it, you can create NFT tokens of the buildings.
Because colleagues from Boston Dynamics say the inspection based on spots is one of the most interesting cases of using these robodogs. And I guess to find option to connect Boston Dynamics robotics systems to blockchain ecosystem, it's a good way to make inspection of buildings in real estate market more profitable and more interesting in cases of using NFT. So from the technical side, what I try to double check for you right now, it's a ROS, it's an open source framework for robotics today. It's only one open source framework for robotics in the last 10 years. And what I saw in the last 7 years with a different type of projects on the frontier between Internet of Things and blockchain, they trying to focus on data marketplace, on the making their own framework to connect data to blockchain. And from our perspective as robotics developers, we think it's not a suitable way to make something to connect IoT, because today IoT, it's hundreds different type of software and robotics in the same time. So you need to find framework before you want to collect data from different sources. So try to find more information about ROS, and maybe you will find interesting ready to work robotics systems, which you will have opportunity to connect to Ethereum or Polkadot blockchain with us, with Robonomics, for example.
Well, thank you very much. I just thought I'd put that up because the real estate data marketplace is a paper that we've just published, which is now available on our website. There it is. Right, it's 5 o'clock. We said we would finish at 5. I'm going to thank everybody for their contributions. We wandered around the agenda, but I think we covered every point that we said we would. I think I've said my thanks to everybody behind the scenes who's been involved. It is a tremendous effort to put one of these things together. Always very interesting. Great support from CMS. Thank you very much, Charles, for your support. We've got lots going on. We've asked if we can keep your data. So if you'd let Ruby know that you're happy for us to retain your data, then we can hold it. Otherwise, we have to be GDPR compliant and we have to destroy the mail list at the end of this incident. I see Johnny Fry's just put his hand up to say something. Are you going to be nice, Johnny, or are you going to be rude? I think he's gone. I think he's gone to the pub. Right, Johnny doesn't get his chance. Thank you very much, everybody. Thanks to Ruby, and we will be in touch when we put our next event on. Thank you very much indeed. Cheers, Carl.
Thank you very much.
Thank you, everyone.